Welcome to this explainer on the unbeatable EMA system. I am absolutely thrilled to have you here today because we are embarking on a highly disciplined masterclass. Look, if you've ever stared at a chart and felt completely betrayed by your indicators, you are in exactly the right place. Today, we're going to completely transform how you view the exponential moving average, or EMA. We are taking it from what is so often a beginner's trap and turning it into a professional sniper's system. We're going to dive deep into the data, focus on combining these moving averages with true market structure to find pinpoint entry points, and learn exactly how to trade with the cold, calculated discipline of a pro. So, why do most traders actually fail with EMAs? Why do so many people blow their hard-earned accounts using literally one of the most popular indicators in the world? Well, it comes down to a few fatal flaws in how most people approach this tool. They see the price pop above a line and they just blindly buy. Or they see two lines cross and instantly think, boom, a new trend has started. They assume a simple touch of a line is some kind of magic signal to enter the market, but as you'll see, without specific market conditions and structural confirmations, these simplistic approaches are just going to lead to getting trapped in fake signals. Here is our game plan for this session. Think of this as our contract. First, we'll cover the EMA trap. Second, how structure breaks the noise. Third, hunting for the optimal EMA. And finally, setting up the entry point. We're moving systematically from debunking myths to concrete backtesting and precise execution. Let's dive in. All right, section 1, the EMA trap and those common beginner mistakes. We really need to unpack the dangerous misconceptions that keep aspiring traders stuck in an endless cycle of inconsistency and frustration. Think about the sharp contrast in trading mindsets here. First, you've got the beginner mindset. This is the impatient, indicator-dependent gambler. They trade every single crossover. They buy blindly just because a candle touched a line, assuming that if the price is above the EMA, it's an automatic uptrend. But contrast that with the pro mindset. The professional actively waits for market structure. They don't just stare at a line, they identify a dynamic area of value. And most importantly, they have the discipline to actively avoid market noise. And speaking of noise, let's clearly define what we are trying to avoid here. Noise is that messy, sideways consolidation zone. It's that teasing, bouncing price action that really isn't going anywhere. Traders who ignore market structure get totally trapped here. If you try to trade a trend continuation strategy inside a sideways consolidation zone, you aren't just taking small losses, you are suffering severe financial pain and basically draining your account. Moving into section 2, structure breaks the noise. Let's establish the fundamental rule of true market analysis so we can filter out all that destructive choppiness. I want you to adopt this as your new trading philosophy right now. The moving average is your compass, but price is king. It's a directional guide, right? It reacts to past data, but price is the actual heartbeat of the market. Every indicator comes from price movement. If you're staring at the EMA but ignoring the story the price structure is actually telling you, you are basically trading blindfolded. So how do we actually read that story? We use the 1-2-3 move. This is exactly how a professional confirms a valid uptrend above the EMA instead of blindly jumping in. Step 1. The price pushes up and creates a new high above the EMA. Step 2. It pulls back slightly and forms a higher low. Crucially, it doesn't break the previous structure. Step 3. It pushes again and decisively breaks that first high, forming a higher high. That higher high, that is your absolute confirmation. The market is now officially in an uptrend and the noise is broken. Now, if you find tracking those exact swings a bit tricky in real time, here is a fantastic, practical visual hack from the pros. When the price touches your EMA and starts bouncing around, just draw two horizontal boundary lines. Put one at the extreme wick of the previous swing high and one at the extreme wick of the previous swing low. That zone between them, that's noise. You do absolutely nothing. But once you get a clean, decisive candlestick close breaking out of those boundaries, boom, that signals the real move and confirms the trend. All right, section 3, hunting for the optimal EMA. This is all about finding that sweet spot, because you can't just slap a random line on your chart just because someone on the internet told you to. Every single market has its own unique rhythm. The absolutely crucial point here is figuring out which EMA your specific market respects the most. Here's your backtesting checklist. You need to scroll through historical data and test the 20, 30, 50, 75, 100, 150, and 200 EMAs. What you're doing is counting how many times the price cleanly bounces off that specific line. A lot of times, you're going to find the 50 EMA is an incredible, most valuable player because it balances catching early shifts without throwing a bunch of false signals. Meanwhile, the 200 EMA is just stellar for macro, long-term trends. The golden rule that separates the disciplined professional from the gambler is this: don't guess. Do the hard detective work, collecting historical data, analyzing these patterns, and building a strategy that fits your market. That is what gives you the precision and unshakable confidence you need when real money is on the line. Which brings us to our final phase, Section 4, setting up the entry point, or what I like to call the sniper execution. This is where your disciplined preparation meets opportunity to create a seriously high probability trade. Let me introduce you to the ultimate sniper setup. There are 3 totally non-negotiable ingredients you have to wait for here. First, the EMA trend. Price absolutely must be moving clearly in the direction of your moving average. Second, the structure zone. You want price to pull back into the EMA exactly where there is an old support or resistance zone that has just flipped. And finally, candlestick confirmation. You never enter just on a touch. You wait for a specific candle pattern to prove the market is actually reacting. Think of this like your ultimate confluence checklist. The EMA confirms your overall direction. The structure level identifies your prime area of value. And that candlestick pattern, like a shooting star rejecting resistance or a strong bullish engulfing candle, that is what triggers your final entry. When you wait for all 3 of these to align perfectly, you are entering a trade where both indicator-based traders and price structure traders are jumping in at the exact same time. And let me tell you, that combined buying pressure is absolute rocket fuel for your setup. And here is the kicker. When you execute this heavily confirmed sniper setup, it creates the perfect sweet spot for a highly profitable risk-to-reward ratio, usually around 1 to 3. Because your entry is so precise and heavily protected by both the EMA and the structural level, you are risking 1 unit to make 3. That completely shifts the mathematical odds in your favor over the long run. So let me leave you with this provocative challenge. Stop guessing and start reading the story the market is telling. Are you ready to completely ditch that gambling mindset? I challenge you right now, as soon as this explainer ends, to open up your charts, apply that 50 EMA, look for that 1, 2, 3 structural move, get in there, and start backtesting this discipline system. Because once you understand the story behind the lines, trading stops being random and starts becoming incredibly powerful. Keep your discipline steel, and I will see you next time.